Oh, it absolutely is. I mean, it was, the central question coming into this week, and then Chairman Powell the other day threw more fuel on that fire, and other Fed speakers as well. So I think everyone has to brace for significantly higher rates here as we go forward.
You say significantly higher. Let's just call the 10-year at 3%. Are you talking 4?
Kelly, I don't know if we're talking 4 here. I mean, there is a significant amount of tightening that's priced into the curve already. I mean, if you look at this year, the market right now is priced for 250 basis points between now and the end of the year, and then another 50 basis points next year. So it would have to ramp up even more for you to get up to, a 4% sort of handle. Now, that said, I think the key things to watch going forward will be the inflation numbers, right? If inflation continues to come in hot here, then those expectations of what the Fed's going to be doing this year and next year may ramp up even further. So that's clearly going to be the key as we go forward.
And what's a little tricky to figure out is people who say, okay, we've now got the markets pricing in so much from the Fed that it's unclear to me whether rates are going to, this upward move will stop as we stop getting more hawkish, if we stop getting more hawkish, or if rates keep going as the normalization continues, as actual, for instance, QE, as that runs off and the Fed starts to shrink the balance sheet, and, how much that kind of continues to unpin the long end, how much whatever is going on with the Japanese currency and some of the, global buyers as well, how much that might affect the direction of long-term rates from here.
Yeah, so there's a lot of tightening that's coming at us, not only the short-term tightening that we're talking about, but also some of the tightening that you were talking about there. The Fed's going to be shrinking its balance sheet. Probably they're going to announce at the next FOMC meeting that that's going to start. The dollar is getting stronger here. Credit spreads, aren't moving out any further, but, corporate borrowing costs are going up. The stock market is selling off right now. There's a fair amount of tightening that's occurring right now in financial markets. And so, as we go through the months here, it's going to be key to see how the data is reacting to that. And you very well could get a point where all of a sudden, holy smokes, the economy's slowing a lot. And then a lot of that tightening then starts to get repriced out of the market.
What do you make of the housing market? How high do you think mortgage rates could go from here? And do you expect activity to drop or more or less just plateau?
So knowing what I know right now, Kelly, I would say I don't think mortgage rates are going significantly higher from here. It's really going to depend upon that 10-year. And again, I don't see that. I think we very well make a run at 3.25, which was the high back in 2018. But that's a quarter of a percentage point from here. So I don't know how much further mortgage rates go, but we are already seeing signs that the housing market is slowing, and we're looking for housing starts to be 1.7 million this year. Next year, we're looking for like 1.5 million. So we are looking for slowing in the housing market, as we go forward.
Yeah, slowing. It's not like it's going to be 06, 07 where we had this huge boom followed by a tremendous crash. It sounds like that's why I keep thinking about this word plateau, that there is still authentic organic demand for housing. There's not a lot of inventory, and there's a lot of room for that to kind of keep going sideways, if not anything else. So add it all up, where does it leave you on the economy? Do you think the Fed needs to push the pedal to the metal here to kind of take the Mary Daly case where she said maybe we need to front load tightening, whereas others have made the opposite argument?
No, I kind of agree with that. And that's kind of what's in our forecast as well. I mean, we think what's pretty much assured at this point would be 50 basis points, obviously, in May, and another 50 basis points in June. After that, it becomes a little bit more data dependent. But, I do believe the Fed needs to get rates up pretty quickly here at first, and then let the data really depend on how things play out going forward. But, then how does that go with our forecast? We're looking for some pretty big deceleration late this year, early next year in terms of the overall economy. We think we'll be growing below trend. The trend rate of growth is somewhere around 2%. We think we're going to be growing, let's call it 1.5% later this year and early into next year.